Dr. Charan Singh, the council members, uh, Dr. Ajit from NITI Aayog and his team, academia, and I can't see much of the students, but my dear students, if at all they are, research scholars also. The topic is, and I'll just be very short, crisp, and would proceed into, now this paper, Basel 3 is a paper, research paper, credit adequacy reforms which have come, that you have to maintain adequacy, then the market liquidity risk, strengthen the bank requirements for the capital, you have to decrease the bank leverage. Once you decrease the leverage, the cost of the deposit will be low and the profitability of the bank is going to be. So it's more of a spillover effect has to be stopped. That is the basis of the Basel 3. How Basel 3 is different from Basel 2 also, I'm just going to skip it in a nutshell. New and new terminologies have come. There are more emphasis on the capital conservation buffer, liquidity conservation. Then the ratio should be greater than 3. What does it comprise of? What is the capital adequacy? And basically, what are the requirements? CET1, CET2, additional capital, subordinated debts, what all comprises? I presume we can all read it from a BIS, BCBS documentation. I am just proceeding and I am taking some presumptions and assumptions that we all are aware of what is there. Now, when in today's world we are looking into the risk management, and with the risk we have a weighted average approach. So the capital divided by the risk weighted, and the three pillars of the Basel 3 remain the same as the Basel 2, the supervisory market and the credit, and you can always develop the norms, but the more emphasis is on the raising of the capital. Capital will speak of the governance, capital will speak of the strength, it will speak of the robustness of the bank, and you will have to look into the various. Now, the modalities, before I start this presentation, the flow chart is very clear that there is an abstract which gives you the whole of the basis, and in the end I have given some conclusions. I have studied approximately 53-54 research papers, reports of the World Bank, BIS documentations, and lot of research papers. This must be my 9th or 10th paper on only on Basel. Risk management, credit risk management, then the operational risk management, stress testing. So various papers are there. Now when I am going to look into this, so I am just skipping all this. When it was formed, then the BCBS came and 74 G10 countries came. Then the Indian banking talks about the economic stress, spillover, transparency very fast now. So with the permission of the chair, I am just going to proceed very fast. Okay. So with the paucity of the time, it's a lengthy paper, but what is the contribution? Literature review about 53-55 research papers I am skipping. Basel 2, Basel 3 difference is very clear that the tier 1 which is not there, these new norms have come. What is the CCB, what is the leverage, what is your liquidity coverage ratio, NSFR which is required for your systemic financial institutions. Raised to about 10%, which is going to be there. The norm is very clear, this is there. Now I am not going to even look into the implementation chart, but only thing is Basel 3 vis-a-vis the PCA guidelines, Basel 3 vis-a-vis the new norms of the which have come for the NPA is galloping. March only, now your NPA of the banks is going to be, the growth is going to come down basically, and 11.6% the government has already announced. And we have a good recovery rate now, considering our IBC which has come to our rescue for the NPA. So we are clubbing everything into one. So it's so the future of the banking is very bright. We have seen the balance sheets of the bank bleeding, but now the balance sheets of the bank are going to be now robust with the Basel 3. Now only thing is, I just only want to just recapitalize and tell you that these are the guidelines, and we are at the minute strong. That means 11.5 as linked to 10.5. So these are fixed, 4.5, then 2.5 is fixed, 1.5 is fixed, additional tier has to be brought in. So this chart talks about your tier 1, tier 2. Systematic important and the SIBs, these are the charts. These are by Reserve Bank of India, and our risk weights are also prescribed. Now implementation we have already done. March 19 was to be done. Now, November 2018, new guidelines have come. They have extended it to another 1 year. That it is going to be 2020. Only thing is, they are just told that we are going to only talk in terms of the capital. That is for only thing is we are changing, and we are allowed to raise capital up to 2020. That's the only changes. Now, basically, the impact analysis is how it is affecting the financial system, how it is going to for the profit margins, supervisory activity, global financial stability. So these are some sub-points which you can already read. Challenges which are there, the capital, basically we know various reports are there, and basically we are going to get about 25 billion expected from the CET1 and CET2. All banks have been told to raise the capital, some banks have already raised. Only thing is, you have to get your debt rated abroad, and Union Bank raised quite a lot. That was again rated by the BRICS, and Indra Dhanush schemes have also come to the rescue of the Basal 3. Now, if you plot these cutter charts and all, I am just skipping this. Buffer requirements is very clear, we have to maintain. The only crux, the mantra of Basel 3 is that capital raising, pro-cyclical buffer, then additional buffer, and it is a counter-cyclical buffer on a proactive pro-cyclical basis. So keep on adding the buffers. That is how we have to look for the time contingency. So the risk has to be maintained, has to be contained, and the capital has to be looked. More emphasis is only on the risk-weighted averages. So RBI has given you about 7 business lines. With that 7 business lines, we have been given the chart of risk weights. Profitability of the banks is going to be your ROE is equal to ROA plus the leverage multiplier. So this, lot of papers you can develop on this on a 2-point analysis. You can have basically your decision tree method, but the leverage ratio should not be, it should be less than the 3%. That is on an average ROE is about 15%. How to curtail it? Leverages have to come down. Debt component has to come down. Only thing is, when I was just talking to one of my friend from Punjab National Bank as DGM Credit and the Economics, Anand Saab, so he said, sir, be very clear, all bankers have to monitor their credit portfolios, and the exit route in a credit is not there, but we must be able to come out of the red, we must be able to point out basically what is the ballooning effect over, and rather than just having the balance sheets bleed. We should not allow them to bleed, which is going on at the minute. Now, this is a chart which is there. When we compare objectives, is very clear. What I am going to do is only I am just giving you some alternative of a Basel 3. Where do we stand now? We are 2019 beginning January. March 31st was the deadline, right? But banks are not still geared up. That's the pessimistic view. Optimistic view is PCA guidance, the researcher has already said, ROA, your CRAR and your profit NPA has to be contained. So some banks are out of PCA, some banks are still struggling, they have to raise their capital. Now, I had collected the data from the various balance sheets, but it's a lengthy paper, working paper going on, and only the public sector banks have been taken and the private sector banks. I have not taken the foreign banks purposefully because the foreign banks are already meeting their disclosure 1, disclosure 2 and disclosure 3 norms. They are already there on the balance sheets, and on the sites also it is available. Now look at into this. This is the model which I developed, and the upper chart is very clear, 2018, 2019. I am taking 18 because November 18 the guidelines have come, extension. So let's put it hypothetically, the common equity is 12.79, and this minimum capital conservation buffer as a percentage of the net is basically determined upon, it's already predetermined. Greater than 6.5, look at how much is the weight. So when it is going to be there, it has to be 0. That means you are going to keep the profit as it is. So basically all these banks are coming into 100% of the risk weighted averages, so they will have to keep the profit as it is in this hypothetical model. The second model, basically look at this, the amount of the percentages to be required by HDFC is 0 because CET1 is within the range of greater than 6.75. 6.75, again you have to look at the chart and you have to put into 100% multiplied by that, so it becomes 0, so they keep the profit. Same is true for all the banks which I picked up. The banks which I picked up from the balance sheets online is HDFC, ICICI, Bank of Baroda and Axis Bank. Look at this, I have just picked up Bank of Baroda, and the rest one is your new generation private sector banks. So new generation private sector banks, why I have taken? Because the PSU banks, still they are undergoing raising the capital. The balance sheets of the new generation private sector banks are consolidated to a much lesser, because the credit consolidation is there. They are not giving credits much. So the amount, the corpus of the credit is lesser over there. But in the private sector, in the public sector, the CET1 ratio has to fall. Now the second caselet we can put is the investment, Government of India securities, investment in the shares, MSME loans, corporate working loans, other loans, cash balance, and the balance with the other banks, and the capital adequacy. Now, what if we have to just look into the portfolio of the counter-cyclical buffer or a cash conservative buffer? How do you calculate the risk weight? My 5 questions, your Basel 3 is clear. First question is calculate the risk weight of the loan portfolio. Second is the risk weight of the investment portfolio. Third is total weight of the assets. Fourth is minimum capital which is required for meeting this capital adequacy ratio. Then you calculate the minimum required CET1. But if you have to look into the profit and loss account also, then this data is not sufficient. Then you have to go for the PNL also, and you will have to take more data. But here if you look into the answer, the risk weighted, let's put it very clear, just categorize them into one. Put the weights, multiply the weights, it comes to 25,000, 2,000, 27,000. Investment would be 2,000 into 125%. This 125 is laid by the Reserve Bank of India into the chart. So we multiply, it comes to 2,500. Total would become of the total investment would be, सबको add कर दो. सबको add means 2,500, 6,000. 6,000 is also given. 6,000 is your other assets. Then 27,000 we calculated earlier, plus the 200. 200 is going to be, which is given here. So we add all this thing, and it comes to 37,500 multiplied by 9% is the chart which is given. 9% we have to maintain the capital adequacy ratio. Just multiply that, and it comes to 3210, 3213. So 3213 multiplied by my 35. This is going to be my fourth. Fourth is, what is the minimum capital for meeting the capital? So it comes to 3213. With the data which is given here, amount is given to you, risk weights are also I have given. So risk weights are given by Reserve Bank of India already into the chart. We put this into and calculate the minimum. It's a very simple caselet which we can devise. Now what we can do is, I have done only 40,000, 2,000, 15,000. When you look into the balance sheets, you can always convert it into rupees into crores. It's already given. If you have to put an international BIS documentation, we convert it into billions. And then we multiply this by the weights and we get into this. So this is one of the methodology which we adopted. Statistically, then I have interpreted the whole of the capital adequacy with the charts. This is the charting techniques, new generation private sector and the old generation private sector. And we find Basel 3 is an uphill task for the PSU banks more. Why? Because balance sheets have to be looked into. Scheduled commercial banks now, with the announcement of Arun Jaitley that there has to be a one mega bank, the number of the banks are going to be reduced to hardly 18. When it is going to be 18, it is going to be some mega merger. One is going to be there, but the other merger, Punjab National Bank, is still deferred. So one Bank of Baroda merger is going to be there, Vijay Bank is going to be there, and the consolidation has already been happening. And if you look into those 3 balance sheets, your disclosure number 3 still is not done. Market. Operational, Basel 3 has taken over Basel 2. Basel 2 we could not do the supervisory. That is why Basel 3 was required. Now, can we have a Basel 4? That is one of the things. When I saw EGROW, one of the challenges, call for papers, I thought I must go for a call for Basel 4 rather than Basel 3. For 3 we are out because 90. Can we? But then the guidelines came that now the results is very clear that you have to have a pressure. As on today, Ind AS has come. IFRS 3 gone. Ind AS 103 has come for a merger with coupled with 27. So when we teach, we look into this. In the banking sector, it is an amalgamation. We don't call it as a merger, we call it as amalgamation, and the High Court also has given the permission now, and the buffers have to be looked into the banking industry. The Indian banking sector industry has to further go on a long way, not only meeting the global capital adequacy norms, but also some strategy has to be adopted. Now the strategy would be a loan disbursement, monitoring, compliances, more. Governance, which is happening, which in the morning session all the CMDs said. I have not taken, I am taking, if I plot another logic probate model or a regression model, I will look into, my biggest error would be my morning session. That is HR. We are doing credit, we are doing supervisory, we are doing operational. So operational, lot of stress models have come. And we call it, in the market we call it as the value at risk, here in the credit we call it as a credit at risk. So we can develop as many as models. The conclusion is very clear, keeping in view that 11.5 by 19, it would be basically imperative for the banks to raise. The source is very clear. As on today, we have a very, very bad loan in the balance sheets. And courtesy PCA, banks have gathered up, geared up PSU. Some banks are coming out slowly and slowly. Their RBI is giving. Your asset quality review is being siphoned, and PCA guidelines are more diluted. So look at the developments which is now. Here, sir, with your permission, only 1 minute. That's it. This is the last slide. Last slide. Now, November 18, Reserve Bank of India has extended it to 1 year. This is because Reserve Bank of India has maintained CRAR requirement by the banks to be 9%. Now, only extension is given to the extent of CCB, nothing else. There is no change in 19, accepting the CCB has to be done. Further, there is a pre-specified trigger for the loss absorption. And it will remain, RWA on, will still remain 6.125. 19, if you look into the implementation, it is 6.125. It will remain. Only thing is that as on today, Basel 4 will have 3 implications. First, the banks are likely to face higher capital requirements. Second, the bank is likely to improve their capital management. Third is the risk sensitive approach. Now we will do the sensitivity analysis, put the weights again. So everything, as my dear friend has also told me, that it has to be risk weighted approach. Unless until the banks have to again remodulate, provisioning is one thing, NPA. But risk weighted averages on the credit have to be looked into on a broader perspective. That's all basically is there. Any questions? Or I know I have rushed up, but it's a very important thing because of the...
Absolutely. Well, thank you, Professor Tandon, for bringing some real perspective, the Indian perspective to Basel III. With that, we turn to Professor Rachita Gulati from the IIT Roorkee. She'll be speaking on bank regulation and competition policy evidence from India and its peers in the BRICS.
Thank you, sir, for introducing me. So very good evening to all of you. So can I have a presentation? So very good evening to all of you. I am today I am here to make a presentation on the topic bank regulation and competition policy evidence from India and its peers in BRICS. So I would like to thank the EGROW Foundation for giving me this opportunity to make a presentation as an academic speaker in this session today. The paper is co-authored with Professor Sunil Kumar from Faculty of Economics, South Asian University, New Delhi. I'll try my best to be on time, and this topic we have thought of to make a presentation is a very important topic. And when we talk about the competition assessment, there are different ways to assess the competition. Till now, if we see the literature, empirical literature on the assessment of the competition, the very foremost approach which is generally used is the structural approach. Basically based on the concentration ratios or Herfindahl index and other indices. And the other approach which has been very much popularized after the new empirical industrial organization literature, that is the empirical methods, basically the empirical measures like Lerner index, like Boni indicator, and the indicators like Penzaro-Z statistics, which has been basically calculated for at a country level by the World Bank and could easily be calculated using the several econometric approaches with the help of like the Lerner index and Penzaros can easily be calculated with the use of the econometric approaches. But the third approach which we have thought of to present here is the regulatory approach, which is basically very much important in defining the policy guidelines related to the competition policy framework in any country. So in this paper we tried to compare, basically compare this regulatory framework by identifying the certain regulatory areas within which we have identified certain indicators which can have a direct or indirect influence on the competition policy framework within the banking markets. So as far as if we talk about the regulations, financial sector has been considered to be one of the most regulated sector, with the banking is heavily regulated. And looking into the point of view that has been provided by one of the author from World Bank, that is Kunt and Peria, they have conducted a study and have observed that any kind of the regulatory impediment to the competition and monopolistic power, it creates an environment in which the few banks can stymie the competition by having a deleterious impact on the efficiency and the stability of the banking system. Besides, the recent studies that has been conducted with a view to assess the regulatory areas within which can influence the competitiveness within the system, they have also argued that the regulatory measures which basically succeed in promoting the competition in some countries may or may not constitute the best practices for the other countries. So keeping in view, if we'll talk about the competitiveness within the banking system, I'll straightforwardly come to the objective of the study by highlighting this point, that there is a need for the different nations, particularly after the global financial crisis, it has been there is a need and the purpose has been arose to design the optimal regulatory architect and with the purpose to foster the competition and improve the efficiency of the financial intermediaries. So what kind of the policy regulations could be useful in promoting the competitiveness within the system, and which has actually to some extent have promoted also, but with the global crisis what has been seen that the competitiveness has after the global crisis, due to the effect of these crises onto the banking system of the several nations, both developing and developed nations, it has influenced the competitive state in the competitive state within the banking markets, and along with that has also somehow shaken the efficiency and the stability of the system. So the policy regulations that can enable the policy regulations like lower entry barriers, lesser restrictions on the business activities, including the securities, insurance, real estate, then banks' entry to the non-financial activities, better resolution practices and the framework, supervisory norms, and the high level of the transparency and information disclosures that have been either amended or introduced within the regulatory framework by the different countries since 1990s, and India has also followed that route. And initially it was the deregulation, then there was a kind of the prudential re-regulation framework that has been adopted, and some of the regulations has been amended. So given this unresolved theoretical view regarding that what kind of the key regulatory areas or the measures which can have an influence on the competition policy and can define the competition policy framework, so this study we have conducted with the three key objectives. First, to identify and then see the developments in the bank regulations governing the competition policy framework in India. Then to compare where India stands vis-a-vis the other nations, particularly the BRICS nations, other developing nations, and to examine whether these bank regulations governing the competition policy has converged to an extent, to what extent it has been converged, which regulatory areas have seen the similar standards as that of the BRICS nations. So if we look into the empirical literature, basically the work on this issue of regulatory approach for assessing the competition policy framework has not been much, and it is only with the availability of the data by the bank regulation and the supervision surveys which has been conducted at the 4 points in time, 2000, 2003, 2007 and 2011 by the World Bank. So some of the information about the regulatory regulatory directions and the policies which are adopted by the range of the country, number of the countries that has been now available, and looking into these this data that is the information that has been provided by the World Bank. We have tried to assess that to what extent in India that competition policy framework has been for the banking markets that has been adopted, and how it has developed over the 4 different points in time. So the last point at which the survey was conducted is 2011, but the report was published in 2013. After that, there was no further survey that has been conducted till now. And few initiatives have been taken by using this data source, which is we can say the new data source. So that survey was basically by the James Bath from the World Bank, and the studies have basically been conducted with the purpose to view that how these regulatory areas can influence the efficiency, can influence the stability, or can influence the competitive state in the banking markets. So one of the study which I have highlighted as a red here, basically this study is a kind of the study which has, this is the only study which has actually gone with the competition assessment, and but has limited to only one point in time, that is 2007. And they compared this competition policy framework of Jordan with its peer economies by using some of the regulatory areas. And they have also analyzed the impact of they have extended it to the calculation of the competition assessment based on the non-structural approaches also, which is another part of our study which we have already conducted, but to be limited here, we are only presenting the regulatory approach. So these are some of the studies which have gone with the use of this data. Then some of the stylized facts, I will not put much emphasis on these stylized facts because Shri Ajit sir has already made the comparison of the state of the India with the China and some of the other BRIC nations. But the point which I will be only highlighting here is that the BRICS region is mainly dominated by the domestic banks, and the more of the concentration is with the public sector banks within the region, and the top concentration, basically concentration with the top 3 banks is very high in the South Africa, with the very less in we can say in Russia. So this, and if we see from the supply and the demand side, the China is on the top, with the India is here, and with respect to China as well as the South Africa is basically leading the other countries. So the database which we have used, that I am already talking about, is the Bank Regulatory and the Supervision Service. So data is 60% of the data set, responses in the data set are the qualitative, and with the 35% the quantitative responses. Advantage is that the data set has covered around the 142 countries in the last survey, and the number of the questions over time has increased based on the regulatory directions and the policies which the different countries are following with respect to the banking and the supervision practices. So we identified the 4 different areas: restrictions on the line of the business activities, entry barriers, bank exit, and the resolution practices and the information disclosures. So this is the methodology which we have adopted for the calculation of the indices, regulatory indices pertaining to the competition policy, and this is based on the sum of the restrictions in each category by the different countries to the total maximum restrictions that could be imposed on the particular regulatory area. And the regional averages has been calculated, and the securities activities have been the least restricted in the BRICS region, and this is nothing but has been clubbed from the information has been clubbed from the survey responses, wherein India has deregulated with the certain kind of the restrictions on 3 different activities, but in 2011 slightly more restrictions have been imposed. And with the real estate activity has completely been prohibited in India since beginning. And if we see the bank owning non-financial companies, that has also been prohibited. Earlier it was unrestricted, but over time it has been prohibited. And the China and India are prohibited from the real estate activities. So higher value means that is a higher indication, higher restrictiveness. As far as the financial conglomerates are concerned, India and China are fully prohibited to own the non-financial firms, and the banks, while in the Brazil they were allowed, and Russia imposed a fewer restrictions. And if we see the conglomerate formation within the region, it has been quite restrictive over the years. It has not been allowed much. So commingling of the banking and non-banking activities has largely been restricted in India. With the on the activity restrictiveness, if we see the competitiveness, the China is the least competitive, followed by the India, South Africa, Russia, and Brazil. Another indicator that has been used is the entry barriers. So four different. So second area is this, and the four different indicators has been used within this dimension. So entry requirements into the banking, total of 8 requirements, 8 licensing requirements are needed for a firm to be operative for a firm to get a license to operate as a bank. So over time, this has been made more stringent to allow the more fit and proper applications to be approved and to be allowed to operate as a bank. So which is somehow good also. And the Chinese bank regulators does not require the one of this requirement, that is a background and experience of future managers. And while the draft bylaws are not required, is basically they are necessary for the BRIC except for the South Africa. So the limitations, if we talk about the foreign entry, bank entry, so I hope that is much clearer that in almost every country, foreign banks are allowed to enter the market through all the 4 routes. And Russia has never allowed the foreign banks to enter through the branch mode, but while the other countries have already been permitting this. And we can see that for India, it has been 100 in all the years. So if we talk about, but there is one one point that we can make out from here with respect to the foreign bank entry, that the fraction of domestic and the foreign entry denials, they has been very high. If we see for the foreign entry denial, it was quite high for India, and if we see for the domestic entry denials, there was 100% denial rate that between the 2006 to 2011.
Dr. Gulati, we'll have to actually get to this.
Sure. So government ownership, it is around the 73.7% of the ownership of the banking assets. Exit practices, India does not have any track record of closing many troubled banks. And if we look for the other countries, India has gone with the government intervention as a route and the nationalization and recapitalization, while the other countries have gone with the other approaches like the banks, open bank assistance, and the route like but bridge bank has not been adopted by any of the country till now, but the public assistance and recapitalization and restructuring has been adopted. So the resolution practice is 3. I'm not going for the prompt corrective action, but we can see based on the statistics that whatever has been discussed since morning in the policy session and bankers and academic session, that the more focus has been laid on adopting the PCA approach. With that, the promptness of the regulator to act on to the situations, and which has actually been in the favor of promoting the competitiveness, and that is higher promptness that to act on to the restructuring and the defining the bank as an insolvent. But India, if we talk about the restructuring and insolvency power, so it was very low with the supervisors. Mainly the courts are responsible for declaring the banks to be the insolvent. If we talk about this Brazil, there was a supervisory authority, and if we talk about that, it explains that how and to what extent that the supervisors may have the power to restructure or to declare a bank as an insolvent bank. So it has been quite lower in India vis-a-vis within that region, and even only the Brazil has it slightly higher. Independence of the supervisory authority, has been 100%. India scored the 100% on this, but in 2011 it has been slightly lower, where that the supervisors' independence to declare the banks or to make a decisions on irrespective of the legislative body. Then as far as the disclosures norm, India has become quite good in terms of making out the disclosures. So India has been very much active in terms of disclosing and all the different types of the requirements that has to be on balance sheet, on audit, on the NPAs, and then net interest margins and other financial. So if we look into the convergence, the strong convergence has been seen in the fulfillment of the licensing requirements for the entry into banking, putting restriction on the conglomerate formation, relaxing the limitations on entry of foreign banks, and adoption of PCA. Weak convergence is on the activity restrictions. Power of official of supervisors to restructure or declare the bank as insolvent has been found to be slightly lower, on which the more reforms and the more action has to be taken. Divergence has also been seen with respect to the government holding the ownership shares. India and China has the greater ownership shares with the government, while the Brazil, Russia has a slightly lower. On concluding note, it is in line with the whatever we are making out the discussions that although the bank entry regulations in India and the other nations have been made more liberal, but banking sector contestability is still lower, it has been observed through the study. Further, the supervisors need to be dispensed with more powers over time, which has declined in 2011, and it may be possible that the powers may somehow be the notional. And finally, if we talk about that, the more is needed with the purpose to make the bank, before we call the banking sector to be the contestable in the market. Thank you.
Thank you, Professor Gulati, for a very enlightening presentation on restrictions as well as contestability and competition within the BRICS. With this, we go to Anamika Singh at IIT Roorkee, who would be giving us a presentation on the impact of size structure on liquidity determinants and the association of the Indian banking liquidity.
Good evening, everyone. Before starting the presentation, I would like to thank Charan Singh sir, my supervisor Dr. Anil Kumar Sharma, and IIT Roorkee for giving me such a good platform to present my idea and quantitative work on liquidity. It is the part of my thesis work. My presentation includes introduction, scope, rationale, objectives, hypothesis, methodology section, then analysis section, then findings and conclusion. Before starting the presentation, I would like to present the concept of liquidity to fund asset increases and fulfill its liabilities without incurring unnecessary cost and losses. And as per the RBI report, when banks increases its assets and accommodates both the certain and uncertain increase in cash demand and related liabilities without undesirable cost and loss is known as liquidity. As I have studied 200 to 300 papers on liquidity, and I have found that there are various factors which affects the liquidity of banks. And these factors can be divided into two sections, bank-specific factors and macroeconomic factors. And while going through the literature review, I have found the paper of Ishan Green and Gupta, and it states that in spite of huge public ownership of banks in Indian Indian economy, it has been experienced that during the financial crisis of 2007 and 9, there was a deposit flight from private sector banks to public sector banks. And somewhat it has inspired me to work on liquidity, the concept of liquidity and its association with various determinants in Indian context. So while going through the literature review, I have found there are various factors such as macroeconomic factors such as GDP, unemployment, inflation, interest rate, and financial crisis, which affects the liquidity of banks, and various bank-specific factors such as cost of funding, deposits, non-performing assets, NIM, etc., which affects the liquidity of banks. to measure the liquidity, I have chosen 4 dependent variables: liquid assets over total assets, liquid assets over total deposits, loans over total deposits, and cash over total assets. And I have calculated these variables while going through the literature. I have found the formula, and from the RBI site it has been given that how to calculate the liquid assets, and through that I have calculated the liquidity. So while going through the review section, I have found that the ownership structure also influences the liquidity level of the banks. So while doing the research in the first section, I have studied the liquidity trends of the banks based on various ownership structure, then time periods such as pre-crisis, crisis and post-crisis, then size structure. And this paper basically presents the effect of various determinants on liquidity and how it varies as the size structure of the banks varies. So, scope of my study is, it considers 63 scheduled commercial banks from the period of 2000 to 2015, and while going through the paper, I have found one of the good paper from working papers of RBI, and they have segregated the banks based on the asset into 4 categories, such as small size banks, medium size banks, large size banks, and largest size banks. So in this study, I have also segregated entire panel into 4 panels. So banks having total assets up to 50 billion rupees, 50 billions are classified as small size banks, and the banks with total assets between rupees 50 billion and rupees 100 billion are considered as medium size banks, and the banks having assets between rupees 100 billion and rupees 200 billion are classified as large size banks, and the banks having asset size above rupees 200 billion are considered as largest size banks. So we have considered all the banks, and we have tried to maintain the balanced panel data. So the new banks which have come up after 2000 we have not considered. So my data set is panel, and we have used fixed effect estimates and random effect estimates to estimate and analyze the long-term effect of these determinants on bank liquidity, and which estimate to follow. This is the biggest question. So to answer this question, I have applied Horseman test on the data set, and I have also applied robust standard error to eliminate heteroscedasticity of data set. So my objectives are to study the change in the influence of determinants on Indian banks' liquidity on small size banks, medium size banks, large size banks, and largest size banks. I have used eViews 8 and Stata as an analysis tool to analyze the data set, and I have derived entire data set from RBI site and CMI database. For this study, I have chosen these variables. Entire analysis is divided into 4 sections. So first section would analyze the small size data set. Next section would analyze the medium size data set, then large bank data set and largest bank data set. I have used these models. So deposits, ROA, that is profitability, cost of funding, non-performing assets, crisis, net interest margin, gross domestic product, capital adequacy ratio, inflation, and bank size are considered as independent variables, and I have observed the influence of these variables on the liquidity of small banks, medium banks, large banks, and largest size banks. So first of all, I have analyzed the descriptive as as we can see, the average liquid assets over total assets maintained by small banks are 24.536, while for medium-sized bank it is 11.675, and while for large banks it is 10.968, and for largest bank it is 8.709. So it clearly indicates that the concept of economies of scale is working over here. And after this, I have also analyzed the liquidity trend of these banks, of these panel, and I have observed that during the crisis, it was the small size banks and medium size banks which was influenced by the financial crisis, while large size banks and largest size banks were least affected. So further, this trend analysis has also influenced me to go further into the research, and I have found through my analysis that there are various factors which affects the liquidity of small size banks, medium size banks, and large size banks and largest size banks. So in the regression analysis of small size banks, we can see that it is the capital adequacy ratio, crisis, profitability, cost of funding, size, inflation, and net interest margins are the factors or independent factors which influences the liquidity of small size banks. So to maintain the adequate liquidity in the small size banks, we have to consider these variables. So through the statistics, we can see that capital adequacy ratio has mixed effect, because in some cases it shows that it has the positive effect, in some cases it shows that it has negative effect. So we cannot conclude that based on these dependent variables that what kind of effect or association does capital adequacy ratio has with liquidity of small size banks. So this is future scope of research to analyze that what is the exact association of capital adequacy ratio with the liquidity of small size banks. Again, here we can see that crisis has the positive effect with the capital asset over total asset. It means that during the financial crisis, small banks keeps on holding the liquidity, and the reason of maintaining the bank stability and to reduce the crisis situation in the banking is a reason when banks maintain the adequate liquidity during the financial crisis. And one of the significant finding of my study is that, and it is quite significant because I have observed this finding in every panel, that crisis here in small size banks has positive effect. Then again, in the medium-sized banks, it is having positive effect with respect to liquid assets over total asset. Then again, in case of large-sized banks, it is having the positive effect in case of capital cash over total asset. Then in case of largest size banks, it has the positive effect in all dependent variables of liquidity. So it clearly indicates that crisis has the homogeneous effect on banks of all size structure, and similar effect I have found while studying the liquidity and the determinants of liquidity with respect to different ownership structure of the bank. So while concluding this study, I can state that financial crisis has the positive effect on the liquidity of Indian banking system. It means that Indian banking system has some mechanism, or they know that to meet or to combat the financial crisis or such situation, we have to maintain the adequate liquidity. And one of the significant finding is with respect to variable, which is GDP. If we look at the result of medium-sized,
we have exactly a minute left.
Okay. In crux, I can say that there are few variables which has the homogeneous effect on liquidity of banks of all sizes, and these variables are GDP, which has the negative effect, financial crisis, which has the positive effect, and cost of funding, which has the negative effect on the liquidity of banks of all sizes. These are the findings of small size banks liquidity, and through this finding we can clearly see that how macroeconomic and bank specific factors influences the liquidity of small size banks. And here these are the findings for medium sized banks, these are the findings for large size banks, and these are the findings for largest size banks. Now from this study I can state that crisis shows the positive impact on the liquidity of banks of all sizes, and during the crisis, Indian banks keep on holding the liquidity to minimize the effect of crisis on banking functions and to maintain the banking stability. Second, cost of funding shows a negative effect on liquidity of small, large, and largest banks. It indicates the dependency of banks on inter-bank market for liquidity. It also highlights that when cost of funding increases, then Indian banks increases its liquidity, or it depends on internal liquidity rather than going for outsourced external funding, because it will cost them. It would cost them. So there are many variables which have heterogeneous impact on the liquidity of banks of different sizes, and there are 3 to 4 variables which has homogeneous effect on liquidity of small of banks of all sizes. So in future we can study and we can analyze why there are heterogeneous effect of variables and how could we control them or maintain them to help in maintaining adequate liquidity of banks of all sizes. So in future, we can go for liquidity analysis of regional rural banks. We can extend our data set, and we can also see that whether there was some impact of liberalization and after liberalization period on the liquidity of banks of different sizes or not. These are some of my references.
Thank you so much,
Anamika
Singh from IIT Roorkee, for a very insightful presentation on liquidity with scale as well as the other factors impacting liquidity.